Yeah, I think the analogy to 2003 is the one that a lot of investors and traders are going to. And it's certainly not as relevant, for one, because of, as you noted, the share of GDP is much higher. Second, this virus appears to be a lot more contagious than that was. And probably the third and biggest reason why investors don't really have a playbook for this is that the global supply chains with just-in-time delivery are far more integrated than they have ever been. We've never been through anything like this. And, I think one of the reasons investors, especially for the first part of this, kind of shrugged it off is because, throughout this bull market, this 10-year bull market, the market's been able to get past the proverbial banana peels by more than any, whether it's Brexit, whether it's the trade war ratcheting up, because we've had the Fed behind us. We've had easy money. And whereas easy money can, solve a lot of ills, but it can't really necessarily get us through this coronavirus. All it can really do is probably, once we do get through to the other side, perhaps make the rebound a little bit stronger.
So, Jeff, is there data that you're looking at or looking for to try to figure out how to position yourself as this crisis continues to unfold, plateau, die down?
Yeah, John, there's something I'm watching very closely, and that's pollution levels in China. Believe it or not, we're rooting for more pollution in China. And here's the reason. This is a supply shock. It's not so much about the virus. Of course, the human toll of that is immeasurable. It's the supply shock impact to businesses and what that might mean for earnings. I think that maybe the proper historical comparison is the March 2011 Japan earthquake, a 9.0 magnitude earthquake that wiped out lots of Japanese manufacturing, hit supply chains around the world, which were eventually restored. But what we had to watch was the restoration of those supply chains. Now we're hearing from China's Ministry of Commerce and the Ministry of Transportation that businesses are coming back online. And there's independent evidence of this from the U.S. consulates in Beijing and Shanghai and other areas that are showing air pollution levels are coming back up again as non-ferrous metals production's picking back up, oil refining's picking back up again. And that may be important and some of what's driving the market today, the idea that the earnings hit from that supply shock may not be as bad as feared.
Jeff, it's an interesting data point, and certainly China is in focus for many reasons. But as we continue to see this coronavirus situation spread to other regions and other countries right now, I think what's so tricky about this is how much uncertainty is out there. And at least from a market standpoint, what that means in terms of potential business and economic impact longer term. I mean, you look at Apple, they came out with guidance almost as quickly as the company came out with guidance. It took the guidance away. How much is actually factored into the market at these levels, especially when you start thinking about earnings into the coming months, coming quarters?
In some sectors, I think companies have been a bit more cautious about the outlook. Some already were suffering from the trade war and the relatively weak economic outlook. I think maybe a sector that is vulnerable is tech. Look, 11% earnings growth expected for this year after 1% growth last year. Given the slowdown we saw in the economy, if we see a similar size slowdown this year, those estimates are vulnerable. It's certainly the earnings probably most vulnerable of any sector in the S&P, given what we've where the expectations are now versus, say, materials or energy, where they've already come down quite a bit. So that's an area we have to look at. The good news is, again, production being restored in a lot of areas, even areas like Foxconn coming back, saying that they're ramping production back up. And we're hearing from a number of retailers in China saying they're reopening stores. So there's some signs that we're seeing maybe some better visibility. But you're right, we still don't know the extent of it. And those areas most vulnerable are the ones with the highest earnings estimates.
Hey, Burns, the 10-year yield now, 1.34, is obviously off of the highs of the earlier session. I wonder, is the bond market saying to themselves, we might see peak and plateau, as World Health said about China, but this is now becoming more a story about Europe?
Well, the bond market right from the start has taken this a lot more seriously than equity investors have, and it typically works that way. And in this case, the bond market is priced in not just the fact that we've had, the supply chain shocks are really second-order shocks. And I think what the bond market has really done a good job, or probably of pricing in, is the fact that, now that you've seen this spread to Italy, potentially spreading to South America, and ultimately probably to the United States, there's likely going to be some first-order shocks, i.e. shocks to demand and thus revenues, which is the one thing that I think that the stock market probably still has not fully priced in.
And finally, Jeff, I got a question on valuations. Totally unscientific, but I remember back in 2000, Bill Gates stepped down as Microsoft CEO right in January 2000. Really convenient time market-wise. We've had Disney CEO Bob Iger step down just yesterday, kind of a surprise. Nike CEO 4 months ago. Might that be a sign that valuations are rich when you get these companies that have been on a nice run, the CEOs in place for a while, saying now is a good time to step back?
That's an interesting observation, although I guess the buyback programs led by those same executives maybe aren't showing the same thing. When we have to take a look at the expiration of these contracts, clearly they're driving a lot of this turnover, but it is an interesting observation, one we'll have to see whether there's more evidence of.